It's time now for a Wall Street Week daily segment, and David Westin is here with us. And of course, you're laser focused on the economy.
Yeah, and Jackson Hole. And what they said today in Jackson Hole, particularly Jay Powell, the chair, as you know, former Treasury Secretary Larry Summers has had some concerns that they might back off too soon, declare victory against inflation. In fact, it may go on longer than we think. And so we talked to him and asked him after Jay Powell's remarks what he took away from it. And Larry said overall he thought that he did address the issues. This is what Larry had to say.
He made clear that he was continuing and echoing the very strong inflation-focused policies that he had called for in Jackson Hole last year. That was the most important thing, that he recognized very clearly that while progress had been made, the battle against inflation was a long way from won. He recognized that there could not be movement away from the 2% inflation target around which the Fed has oriented its policy. He recognized the prospect that the neutral interest rate had risen. Not explicitly, he didn't use the words neutral interest rate, but he noted that growth was much faster than many people expected, given how high interest rates have been pushed. And that was something that the Fed was going to have to stay focused on. So I was very pleased with the speech, and I think it will reinforce the growing sense in markets that after whatever happened in 2021, the Fed had regained its bearings and was now very focused on maintaining price stability as a basis for long-run prosperity. And I was very glad to see that. And I think the strategy that was put in place a year ago in Jackson Hole, to the surprise and chagrin of many, has proven to be effective, and I was very glad to see that it's going to be continued. Sure, there are other issues that the chair could have addressed. I would have liked to see a little more recognition of the complexities for monetary policy brought about by the nation's problematic fiscal posture. But overall, I thought this was a very good and encouraging speech for the medium-term prospects of the American economy.
Larry, I'm so glad you raised the fiscal policy, because that's something you raised in your Washington Post piece, and it's very much out there to what extent the yields have actually increased because there's so much more issuance, and there will continue to need to be issuance because of the money we're borrowing. I wonder about the neutral rate and how it fits with that, and are we really taking that into account? Let me put it a different way. Are we at a sufficiently restrictive number policy right now for monetary policy to get us down to 2% within a reasonable period of time, given all the other factors?
I don't think any of us can know the answer to that question. I don't think any of us should prejudge that question. My best guess would be that we're going to need more interest rate increasing, because I don't think there's a lot of contraction that is still in the pipeline. And, you know, some forecasts, and they won't actually materialize, are saying GDP growth could be 5% in the third quarter.
In Chair Powell's remarks, he said that some progress was made on inflation. He was quick to say we're not there yet and we need to stay the course, and we'll have to course adjust going forward. One of the things that you have raised that's caused some comment is a comparison with what happened in the 1970s with inflation, where it came down and then it bounced back up again. What, from your point of view, is the relevance of that and the danger that we could have a rebound in inflation?
As people who are more on team transitory and have taken a dovish posture on all this completely for the last couple of years have said, and they're right, The 1970s are very different from now. We had a big recession. We had oil shocks in a larger way than we have now. The CPI was computed differently than we do now. And they're right about all of that. But I think the broader lesson is that the most serious inflation problem the country ever had got made by people who declared victory prematurely several times. In the late 60s, in the early 1970s, and again, as President Carter was coming into office, where even when the inflation problem was still there in reality, the policy discussion began with a lot of orientation to stimulus. And so in that sense, I think the 70s are a useful and cautionary reminder about the mistake that we could easily make. You know, it's always a good idea to think about temptation. And the temptation is always to make things easier, support markets being higher, provide a bit of extra stimulus to the economy. But ultimately, that can become a treadmill. And what's fortunate is that the Fed is now in a quite credible posture. The reason the Fed is in a credible posture is not because it's automatically always going to be credible. It's because it recognized how far off things had gotten, how far off track they had gotten during 2021, and they made radical policy adjustments of a kind that almost no one expected and that many people were counseling against. And that's what enabled us to have our credibility. And so I think it would be kind of a tragic irony if, having regained credibility, we took that credibility as some kind of argument to stop pursuing the policies that had enabled the Fed to regain its credibility.